Today, we're diving into two powerful trading concepts that can change the way you see the market: fair value gaps and inverse fair value gaps. These ideas help us spot opportunities others might miss. Let's break them down and see how they can sharpen your trading edge. Let's talk about a fair value gap, or FVG. It's a price pattern made up of three candles, showing where big players in the market have acted strongly. The middle candle moves so sharply that it creates a gap, a space where little or no trading happened. This gap signals an imbalance caused by strong buying or selling. According to smart money concepts, price often comes back to these gaps to fill them before moving on in its trend. Let's break down how the fair value gap, or FVG, forms in price action. It starts with the first candle, which sets the initial price range. Its high and low create the boundaries we'll watch. Then, the second candle bursts out aggressively, pushing strongly up or down. This move creates a clear imbalance, showing one side taking control. Finally, the third candle's wick doesn't overlap with the first candle's wick, leaving a gap. That gap is the FVG, a zone where price moved inefficiently and is likely to return. When trading a bullish fair value gap, we wait for the price to pull back into the gap zone. This retracement gives us a chance to confirm the move, maybe with a rejection wick or an engulfing candle. Once we see that bullish signal, we enter long, placing a stop just below the gap. Our target, the next liquidity level above where the move started. This gap forms during a strong upward push, showing aggressive buying and a clear imbalance in price. It's a powerful clue for what might come next. When a bearish fair value gap forms, it's usually during a sharp drop in price, a move so quick it leaves a gap where trading didn't happen. This gap shows an imbalance between buyers and sellers. What often follows is a retracement. Price moves back up to fill that gap before continuing down. Traders watch this closely. They see the retracement as a chance to enter short positions, placing sell orders inside the gap and stops just above it. It's a high probability setup in a downtrend. Let's talk about the inverse fair value gap, or IFVG. This happens when price comes back to a previously identified gap, but instead of bouncing off it, the price breaks right through, flipping the role of that zone. What was once support becomes resistance, or vice versa. This flip tells us the market sentiment has changed. To trade IFVGs, wait for a full breach, mark the zone, then enter on a retest with confirmation. Always set your stop loss just beyond the zone, and aim for the next liquidity area or imbalance. Let's talk about bearish and bullish fair value gaps, or FVGs, and how they can flip roles. A bearish IFVG starts with a bullish gap during an upward move, but then price reverses and falls back through it. This flip turns what was support into resistance, a zone where sellers look to enter on rallies. On the flip side, a bullish IFVG begins with a bearish gap during a downward move, but price breaks back up through it. That flips resistance into support, where buyers seek pullbacks for long entries. Understanding these flips helps us spot key trading opportunities. When trading an inverted fair value gap, or IFVG, we wait for the price to pull back into the gap zone that was just violated. If it's a bearish IFVG, meaning the original gap was bullish, we look to enter a short trade. For a bullish IFVG, which used to be bearish, we go long. The key is using the gap's boundaries as precise markers for both entry and stop-loss levels. This way, we trade with clarity and control, respecting the shift in market sentiment. In trading fair value gaps, managing risk is key. We place our stop-loss just beyond the far edge of the gap. This way, if price fully closes through it, the setup is invalidated. For take profit, we aim for the nearest previous swing high or low, depending on the direction, targeting at least a 1 to 2 risk-to-reward ratio. For entry, we wait for price to retrace into the gap, then look for a rejection candle inside it like a pin bar or engulfing candle, and enter on its close. This approach helps us balance risk and reward effectively. When price fully breaks through an existing fair value gap, we mark that zone as a high-probability entry area. We wait for price to retrace back into this violated zone, then look for confirmation, like a rejection candle or overlapping order blocks. This tells us the zone is holding as new support or resistance. From there, we enter in the direction of the new trend. The IFVG helps confirm whether we're seeing a reversal or a strong continuation. It's a powerful way to time our entries with confidence. Let's break down the difference between fair value gaps and inverse fair value gaps. A fair value gap, or FVG, happens when price moves so fast it leaves a gap between two candles, a zone that price often comes back to, acting like a magnet for trend continuation. Now, an inverse fair value gap, or IFVG, is when that same zone gets broken through and then tested from the other side. It flips roles, becoming a key area for reversals or new trends going the opposite way. Understanding this flip is crucial for spotting trade opportunities. To wrap up, start by practicing on higher timeframes. This gives you a clearer, bigger picture. Then, refine your entries on lower timeframes for precision. Remember, mastering fair value gaps and imbalance fair value gaps takes patience and practice. Now, it's time